a beginner investor and you're wondering what to look for when choosing individual stocks to add to your investment portfolio, this video is for you. I'll be sharing 5 things to consider when choosing an individual stock. So let's go. Before you ever invest in any company, you should take the time to understand what that business does. Never invest in a company whose business you do not understand. And some basic questions you can ask yourself are, what products or services does this company offer? What problem does this company solve? Who is the company's target market? And how is this company doing in comparison to their competitors? And all of this information is available by doing some research online, and a good test of whether or not you really understand a concept is if you can teach it to someone else. So maybe try explaining this company to a friend and seeing if they understand what you're talking about. At the end of the day, you are responsible for making your own investment decisions. So don't just rely on what you hear from other people or what you see on social media, because it really is your money on the line. So you should take accountability for that. I'm not saying this to scare you or to discourage you from investing. The point that I'm really trying to drive home here is to really understand the company that you are investing in so that you are fully comfortable with the decisions that you're making. As you journey to understand a company's business, one thing that you'll really want to hone in on is profitability. There are a number of different ways to measure the profitability of a company, but one of the best ways is to take a look at the return on capital. It shows how much profit the business is making compared to the money it is putting into the business. And of course, we want to be sure to invest in companies that are using the money wisely so that it will continue to be a profitable investment for the future. To calculate the return on capital, divide the company's operating income, which is earnings before interest and taxes, by the total capital, which is the sum of equity and debt, and then multiply that figure by 100. So the return on capital is expressed as a percentage, and the higher that percentage is, the better. A good return on capital can vary from industry to industry, but in general, any number that is 20% and above year over year is a good sign. Another ratio that is helpful to evaluate is called the price to earnings ratio, or the PE ratio, and this ratio measures the relative value of a company's stock. The formula to calculate the PE ratio is pretty simple. All you have to do is take the current stock price and divide it by the earnings per share. Earnings per share is calculated by dividing the company's net earnings, or the profit, by the total number of outstanding shares of stock. EPS represents how much profit the company has generated for each outstanding share. Or you can also easily find the PE ratio of the company you're looking for by searching the company name or ticker symbol on Google, Yahoo Finance, or Morningstar. The PE ratio indicates how much investors are willing to pay for each dollar of earnings generated by the company. When it comes to interpretation of the PE ratio, this can really vary depending on the industry and also the stage of growth that the company is in. Some industries naturally have higher PE ratios because there is a lot of growth expected in that industry, while other more mature industries may have lower PE ratios. So evaluate the PE ratio of the company you're interested in relation to competitor companies so that you can get an idea of the benchmark. A high PE ratio can really mean one of 2 things. Either the company's stock is overvalued, or investors are willing to pay a higher price because they are expecting higher growth rates in the future. A low PE ratio could mean that either the company is undervalued or there are concerns about the company's future. So because there are nuances to understanding the PE ratio, it should not be used as a standalone metric, but rather in conjunction with other ratios and research that you perform. So I know we've covered a lot so far, but I hope you're still sticking with me. If you made it to this point, be sure to like this video and then also subscribe to my channel for more on money. Now let's keep going. Another important concept to understand is volatility. And volatility, or beta, is a measurement of the stock's movements over the past 5 years. And beta is actually calculated through a regression analysis, but we do not have to get into that formula here today because you can easily just find the beta of the company you're looking for by searching the ticker symbol on Google or Morningstar or Yahoo Finance. When evaluating the beta, think of the S&P 500 as the baseline index. And a stock with a beta greater than 1 means that that stock has a lot more volatility compared to the overall market, while a beta less than 1 means that that stock has less volatility compared to the overall market. So high volatility with a beta greater than 1 means higher risk, and low volatility with a beta less than 1 means lower risk. Now remember that with investing, high risk also means the potential for high reward, but you could also lose some money in the process. So think about your risk tolerance and how much risk you are actually willing to take. Another factor to consider when evaluating a company is dividends. Dividends are distributions that a company pays out to its shareholders. How much they actually pay out is decided by the board of directors, and most of the time that payment comes in the form of money, but some companies have been known to pay out dividends in the form of shares. Dividends are a really easy source of passive income, and I think it might actually be one of the most passive income streams out there, because once you purchase the shares, you don't have to do anything else on your part to receive a steady stream of money. And some companies pay out dividends monthly, some pay out quarterly. It really just varies. It is a good sign if a company pays out dividends because it means that they are profitable enough to reward shareholders in this manner. If your goal is to build a passive income stream using dividends, then you may want to check out some of the sectors that are known for paying great dividends, and those are oil and gas, telecom, utilities, and REITs. I also recently just posted a video on my channel about the top 5 dividend ETFs to invest in, so click the video on the screen right now to learn about those.